Tesla stock is in an absolute free fall. What's going on? Since the start of the year, Tesla shares have dropped 64%. And just since the start of the month, they're down 35%. That's a monster drop. But you can't make sense of the decline in Tesla stock without first understanding where it's coming from. This is a stock that rocketed into the stratosphere in 2020 and 2021. From the start of 2020 to when it peaked in November 2021, Tesla stock increased nearly 15-fold. A $10,000 investment would have turned into nearly $150,000. But that's not all. At its peak, Tesla was valued at $1.2 trillion, making it the sixth most valuable company in the world. So why did Tesla stock go up so much? Well, to answer that question, I think it's helpful to break the value of Tesla stock into three components. One is the intrinsic value of the business itself. Tesla is a pioneering electric vehicle company. The firm is widely credited with driving the adoption and development of EVs while inspiring other automakers to make their own EVs. The company took major risks to get to where it is today. In fact, Tesla was reportedly on the brink of bankruptcy as recently as 2019. But Elon Musk was able to turn things around for the company and in the process bring EVs into the mainstream. As you can imagine, valuing an early stage growth company in a brand new industry like Tesla is extremely difficult to do. If things had gone wrong, Tesla's stock could have fallen to zero. But fortunately, things worked out and Tesla became the clear leader in an industry that's disrupting the massive automobile market. In 2020 and 2021, as Tesla increased the production of its vehicles by threefold and generated more than $10 billion of profits, the stock took off. For Tesla's stock to go up was a completely rational reaction to Tesla's business becoming stronger and more profitable. But to go up is one thing. To become the sixth most valuable company in the world with a $1.2 trillion market cap is something else entirely. There was another factor that drove Tesla to those insane heights: the COVID bubble. After COVID hit in early 2020, the government unleashed a tsunami of stimulus. Everything from thousands of dollars worth of direct payments to people to zero interest rates. That, combined with the unique circumstances of the pandemic where millions of people stayed home and began trading stocks for the first time, led to an asset price bubble. The COVID bubble sent prices for everything in the stock market through the roof, but high growth stocks went up the most. And stocks of electric vehicle makers were especially hot. A Tesla competitor called Rivian was given a ridiculous $150 billion valuation after it IPO'd in November 2021, even though the company had only built 1,000 vehicles that whole year. Now that brings us to the third component of Tesla's value: Elon Musk himself. In 2021, Elon had become a larger-than-life figure. He was hailed as a genius for turning Tesla and SpaceX into highly successful companies despite operating in extremely complex industries. Anything that Elon touched seemingly turned into gold, so people wanted to invest in his companies. Out of all of Elon's companies, Tesla was the only one that was publicly traded, so naturally it attracted a lot of money from Elon fans. This created what you could call an Elon premium in the stock price, pushing it higher than where it would otherwise be without Elon at the helm. So all three of these value components were at their peak when Tesla stock hit its all-time high in late 2021. The outlook for the underlying Tesla business was looking extremely bright, the COVID asset price bubble was raging, and the Elon Musk premium was at a really high level. But since the stock peaked 13 months ago, one by one, these bullish factors have been unraveling. The first to break was the market environment. The COVID bubble popped in spectacular fashion in 2022. Stocks including Meta, Amazon, Alphabet, and many more have plunged as interest rates have soared, and investors are no longer willing to pay exorbitant prices for growth stocks. But take a look at this chart. You'll notice that up until October, even though Tesla was down, it was holding up much better than all of these other stocks. Something changed in that month. I don't think it's a coincidence that Elon closed his acquisition of Twitter in October, the same month that shares of Tesla began to perform so poorly. With Elon's full attention on Twitter, there's been this growing perception that Tesla is being neglected. But not only that, the view that Elon is an infallible genius has come under strain as people have witnessed the chaos at Twitter. He's also lost some credibility after repeatedly selling Tesla stock, even after telling investors that he wouldn't sell any more shares. So the Elon premium that was embedded in Tesla stock has deflated. But that's not the only thing that Elon's antics have impacted. Since becoming CEO of Twitter, Elon has become a more polarizing political figure. This has likely hurt Tesla's brand, especially among the liberals who have historically bought the majority of Tesla cars. For example, California, a left-leaning state, accounted for 39% of Tesla sales in 2021. Typically, the politics of a CEO of a company doesn't have that much impact on the demand for a company's products. But as a brand that's closely associated with its founder, Elon Musk, you can imagine that sales at Tesla might be negatively impacted by everything that he's saying and doing at Twitter. But Elon's activities at Twitter aren't the only thing hurting Tesla's business. We've seen reports that in China, Tesla sales are faltering because of economic weakness in that country. The car market in the US has also seen some slowing recently as well. So all these factors together are pushing Tesla stock lower. And I'm sure a lot of you are wondering, when is this going to stop? Well, it's impossible to say. What we can say is that the cyclical factors working against the company, like the slowdown in sales in China and the US, will eventually reverse. Those are short-term concerns, not long-term concerns. Longer term, what's important is that Tesla is entering a new phase. It's going from being a pioneering EV company that succeeded against all odds to being the leading EV manufacturer with a target on its back. For the first time in its history, Tesla is facing legitimate competition from other car companies who have their own EVs. According to analysts at S&P, the number of EV models on the market will more than triple from 48 to 159 by 2025. The analysts believe that Tesla's EV market share will also decline from 65% to less than 20%. A 20% market share of a fast-growing industry would still be great, but will it stop there or head much lower? That's an important question that investors need to answer in order to figure out what the appropriate value for Tesla stock is. But there are other questions as well, like how profitable will Tesla ultimately be? Will Tesla's brand be tarnished by Elon's antics? Can Tesla maintain a strong presence in China despite growing tensions between that country and the US? And perhaps most importantly, will investors be willing to continue paying a premium multiple for Tesla stock? Because you have to remember, even after its decline, Tesla is still an expensive stock, with a market value double that of the next largest automaker, Toyota, even though it makes half the profits. A bet on Tesla is a bet that the company can maintain a very high market share in the electric vehicle market while maintaining high growth and high profit margins as well. We'll see what happens. Subscribe for more investing insights.